Preparing for a Kuwait Finance House KFH interview questions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Kuwait Finance House? KFH stands out because it combines scale in Kuwait with a clear Islamic banking identity. I would link my interest to Shariah-compliant finance, customer trust, and disciplined risk management. I also mentioned that KFH is active across retail, corporate, investment, and treasury services, so the learning curve is broad. My answer would show I understand the bank's values and can contribute through accuracy, service mindset, and ethical judgment. While answering, focus on KFH's Islamic banking leadership, Kuwait and regional presence, ethical finance model, customer-centric culture, and how your skills match banking, accounting, risk, operations, or relationship management roles. Question 2. What do you understand by Islamic banking, and how is it different from conventional banking? Islamic banking is finance structured around Shariah principles, especially avoiding riba, excessive uncertainty, and prohibited industries. Instead of lending money for interest, the bank uses contracts like Murabaha, Ijara, Mudaraba and Musharaka. For example, in Murabaha, the bank buys an asset and sells it to the customer at a disclosed profit. The key difference is that returns are tied to an underlying asset, service, or business activity, not simply the passage of time. Make sure to cover prohibition of interest, asset-backed or trade-based financing, profit and loss sharing, Sharia governance, risk sharing, and the practical difference between charging interest and earning profit from compliant transactions. Question 3. Explain Murabaha financing as if you were speaking to a retail customer. Murabaha is a cost-plus sale, not an interest loan. I would explain it simply. The bank purchases the asset you need, such as a car or equipment, then sells it to you at the original cost plus an agreed profit. The total price and payment schedule are known upfront. That transparency is important. The customer is not charged variable interest. Instead, they pay the agreed sale price over time. In your answer, talk about purchase cost, disclosed profit margin, asset ownership sequence, repayment schedule, customer transparency, and why Murabaha is commonly used for consumer, auto, real estate, and trade financing. Question 4. How would you assess whether a corporate customer is creditworthy? I would start with repayment capacity, not collateral. That means reviewing revenue stability, margins, operating cash flow, debt levels, working capital needs, and covenant headroom. Then I would assess the industry, customer concentration, management track record, and account conduct with the bank. Collateral supports recovery, but it should not be the main repayment source. For KFH, I would also ensure the proposed facility structure and purpose are Shariah compliant. Be sure to mention financial statement analysis, cash flow capacity, leverage, collateral, business model, industry conditions, management quality, repayment source, account behavior, and how Islamic structures still require strong credit risk assessment. Question 5. What is Ijara, and how does it appear from a banking perspective? Ijara is a leasing structure where the bank owns an asset and leases it to the customer for agreed rentals. The customer gets the right to use the asset while ownership remains with the bank during the lease period. In many retail or real estate cases, Ijara may end with ownership transfer through a separate promise or sale arrangement. From the bank's perspective, income is rental-based and supported by an identifiable underlying asset. While answering, focus on leasing mechanics, bank ownership of the asset, customer usage rights, rental income, maintenance responsibilities, Ijara ending with ownership transfer, and comparison with conventional lease or loan products. Question 6. How would you handle a customer who is upset about a delayed transaction or service issue? I would first listen without interrupting, acknowledge the inconvenience, and confirm the exact issue. Then I would check the transaction status, identify whether it is an operational, compliance, or system delay, and give the customer a realistic next step. I would avoid overpromising. If escalation is needed, I would document the case and follow up within the agreed timeline. In banking, service recovery is about speed, accuracy and trust. Make sure to cover empathy, ownership, fact-finding, internal escalation, clear timelines, compliance boundaries, documentation, and maintaining customer trust without making promises you cannot control or approve. Question 7. What financial ratios would you review before recommending a financing facility? I would focus on ratios that explain repayment capacity. Key ones include current ratio, quick ratio, gross and net margins, debt to equity, debt service coverage, interest or profit coverage, and operating cash flow to total debt. I would also review receivable days, inventory days, and payable days for working capital pressure. A ratio by itself is not enough. I would compare trends over time, peers, and the customer's business model. In your answer, talk about liquidity, leverage, profitability, debt service coverage, operating cash flow, working capital cycle, trend analysis, peer comparison, and why ratios must be interpreted with business context. Question 8. How does KFH ensure Shariah compliance in its products and transactions? Shariah compliance is not just a label. It is built into product design, documentation, execution, and review. A bank like KFH relies on a Shariah supervisory board to approve structures and guide permissible activities. Operations and business teams must then follow the approved contracts exactly. Internal Shariah review, compliance checks, and audits help confirm transactions match the approved process. Any deviation can create reputational, legal, and customer trust risk. Be sure to mention Shariah Supervisory Board oversight, product approval, contract documentation, transaction purpose screening, auditor review functions, staff training, and ongoing monitoring after product launch. Question 9. What is the difference between Mudaraba and Musharaka? Mudaraba is a partnership where one party provides capital and the other provides expertise or management. Profits are shared based on an agreed ratio, while financial loss is generally borne by the capital provider, unless there is negligence or misconduct. Musharaka is different because all partners contribute capital and share profits by agreement, while losses follow capital contribution. In interviews, I would stress that both are risk-sharing structures, not fixed interest lending. While answering, focus on capital contribution, management responsibility, profit-sharing agreement, loss treatment, risk participation, and typical banking applications such as investment accounts, project finance, and partnership-based financing. Question 10. Tell me about a time you worked under pressure and had to maintain accuracy. In my last academic or work project, I had to finalize a financial analysis under a tight deadline while handling changing inputs. I prioritized the critical schedules, created a checklist, and reconciled totals before submitting. When I found an inconsistency, I flagged it early instead of hiding it. The final output was submitted on time and reviewed without major corrections. That experience taught me that pressure is manageable when controls are simple and disciplined. Make sure to use a STAR structure. Describe the deadline, controls used, prioritization, reconciliation or review steps, stakeholder communication, and measurable result without exaggerating your role. Question 11. How would you explain International Financial Reporting Standards 9 expected credit loss to a non-finance colleague? International Financial Reporting Standards 9 expected credit loss is a way for banks to recognize potential credit losses earlier. Instead of waiting until a customer defaults, the bank estimates future losses using probability of default, exposure amount, and likely recovery. Assets are grouped into stages depending on credit quality. If risk increases significantly, provisions rise. I would explain it as a forward-looking safety buffer that protects the bank's financial statements and reflects changing credit conditions. In your answer, talk about forward-looking impairment, probability of default, exposure at default, loss given default, staging, credit deterioration, and why banks provision before actual default occurs. Question 12. What risks are most important for an Islamic bank, like KFH? For KFH, credit risk is central because financing customers must repay from real cash flows. Liquidity risk is also important because the bank must meet withdrawals and funding needs while using Shariah-compliant instruments. Market risk affects treasury portfolios, profit rates, and foreign exchange. Operational and cyber risks matter in digital banking. Islamic banks also face Shariah non-compliance risk, which can damage reputation and require income purification or product correction. Be sure to cover credit risk, liquidity risk, market risk, operational risk, Shariah non-compliance risk, reputational risk, concentration risk, and the need for governance across products and customer segments. Question 13. How would you cross-sell banking products without pressuring the customer? I would start by understanding the customer's need, not by pushing a product. For example, if a salary account customer often asks about savings goals, I may explain suitable savings or investment options after checking risk appetite and eligibility. I would be transparent about fees, terms, and obligations. Cross-selling should feel like advice, not pressure. In a bank like KFH, ethical conduct and customer confidence are more valuable than one quick sale. While answering, focus on needs-based selling, customer suitability, ethical conduct, product knowledge, transparency on fees and obligations, regulatory compliance, and long-term relationship value rather than short-term sales targets. Question 14. What would you check before processing a customer transaction to reduce compliance risk? Before processing, I would verify the customer's identity, account status, transaction authority, and required documents. I would consider whether the transaction matches the customer's profile and declared purpose. If anything looks unusual, such as inconsistent source of funds or sanctions concerns, I would escalate through the proper compliance channel. I would also respect confidentiality and approval limits. The goal is to serve the customer efficiently, without weakening AML, KYC, or internal controls. Make sure to mention KYC, customer identity verification, source of funds, sanctions and screening checks, transaction purpose, unusual activity escalation, documentation completeness, approval limits, and data confidentiality. Question 15. If you noticed an error in a report submitted to management, what would you do? I would first verify the error and quantify its impact before escalating. If the report influenced a decision or regulatory submission, I would inform my supervisor immediately and provide the corrected version with a clear explanation. I would not quietly adjust it without ownership. After correction, I would identify why it happened, whether from formula logic, source data, or review gaps. In banking, credibility comes from raising issues early and fixing controls. In your answer, talk about integrity, immediate verification, impact assessment, transparent escalation, corrected resubmission, root cause review, control improvement, and why banking culture values early issue identification. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.